sanctions are not about risk management. They are about prohibition. In anti-money laundering, institutions mitigate risk. Under sanctions law, there is no balancing test. There is no acceptable risk threshold. Any sanctioned transaction must be blocked. Crypto is instant, but sanctions law remains static. Digital assets move instantly. Violations are assessed under strict liability. That means intent does not always matter. Even accidental exposure can trigger enforcement. This is where many crypto firms misunderstand their risk. AML monitors suspicious behavior, sanctions block prohibited relationships. Blockchain is irreversible. Failure to block in real time means permanent exposure. Sanctions compliance is an existential risk management function. Because once a transaction is processed, the violation has already happened. Sanctions in crypto are not theoretical. They have already reshaped the industry. In 2023, Binance paid $968 million for sanctions violations involving Iran, Cuba, and Syria. This was a systemic failure to block prohibited access. In 2022, Kraken paid $360,000 for Iran-related transactions. Even limited exposure triggers enforcement. Then came Tornado Cash. The U.S. Treasury designated the smart contract code itself, triggering global shockwaves. Not a company, but code. Exchanges delisted tokens and developers were arrested. Sanctions apply even to decentralized infrastructure and code-based property. Speed and innovation do not limit enforcement authority. Sanctions law reaches further than most crypto firms ever expected. Sanctions are not just political tools. They are legal control mechanisms embedded in financial systems. Every sanctions regime has three core elements: designation, prohibition, and enforcement. First, designation. In the US, this is handled by OFAC. In the EU, through Council regulations. In the UK, by OFSI. Second, prohibition. Once designated, it is illegal to provide funds or services to that target, directly or indirectly. Routing funds through intermediaries does not eliminate liability. Third, enforcement. Authorities can impose civil penalties, criminal charges, asset freezes, and operational restrictions. Sanctions do not require proof of money laundering. They require only one thing: a prohibited transaction. This makes sanctions uniquely powerful in crypto. Frameworks are strict by design, and crypto firms are fully within their scope. When we talk about sanctions in crypto, we're usually talking about OFAC. It's part of the U.S. Treasury Department. Its authority comes from a federal law called IEEPA. Under it, the president can declare a national emergency to block assets. The most important tool is the SDN list. If a person or organization is listed, U.S. persons are prohibited from dealing with them. Assets must be blocked. It applies to U.S. citizens, companies, and anyone physically in the States. In crypto, this means a single wallet address can be designated. Once listed, any transaction touching that address creates sanctions liability. OFAC does not need to prove money laundering. It only needs to prove a prohibited transaction. That's why understanding OFAC is essential for crypto compliance. Not all sanctions regimes work the same way. The US model is centralized and executive-driven. The European Union model is political and multi-layered. In the United States, sanctions authority is activated through a presidential emergency under IEEPA. OFAC then designates individuals directly onto the SDN list. It is fast. It is unilateral. And it often has extraterritorial impact. The European Union operates differently. Sanctions are adopted through decisions of the European Council and implemented through binding EU regulations. There is no single EU OFAC. Instead, enforcement happens at the national level within each member state. U.S. sanctions frequently apply to non-U.S. actors through secondary sanctions risk. The EU model is generally more territorial. In crypto, this creates operational complexity. A transaction that violates US sanctions may not automatically violate EU sanctions. And vice versa. For global exchanges, sanctions compliance is multiple overlapping systems. Understanding those differences is an operational necessity. One of the most misunderstood concepts in sanctions compliance is the 50% rule. If sanctioned individuals collectively own 50% or more of an entity, that entity is automatically sanctioned. Ownership alone triggers blocking obligations. This is critical in crypto, where corporate clients may have layered ownership. Now compare that to the European Union. The EU applies ownership and control principles. Control may exist even below 50%, through influence over decisions, voting rights, or operational authority. The UK applies similar ownership and control tests through OFAC, but interpretation may differ from OFAC. For crypto firms operating globally, this creates real complexity. Sanctions screening is not only about checking names. It is about understanding ownership structures. Beneficial ownership attribution determines whether a transaction is lawful or prohibited. Not every sanctions violation is criminal, but every violation is serious. The difference between civil and criminal enforcement depends largely on intent. Civil violations occur under strict liability. OFAC doesn't need to prove intent or knowledge. If a prohibited transaction occurred, a penalty may be imposed. This applies even if the violation was unintentional. In contrast, criminal violations require proof of willfulness. To pursue criminal charges, the government must prove the person knew the conduct was unlawful and intentionally engaged in it anyway. This requires evidence like internal communications or deliberate circumvention. In crypto, this distinction is critical for your compliance strategy. A screening failure may trigger civil exposure, but deliberate circumvention may trigger criminal liability. Repeated violations and obstruction, like deleting records, escalate risk significantly for crypto firms. It determines whether a company faces a fine, or whether executives face prosecution. Ultimately, intent changes everything. Sanctions compliance in crypto begins with wallet screening. If a wallet address appears on the SDN list, transactions involving that address must be blocked immediately. But most exposure is not direct. It is indirect. This is where address attribution becomes critical. Blockchain analytics tools group addresses into clusters based on behavioral heuristics. These clusters are then attributed to entities, exchanges, darknet markets, ransomware groups, or sanctioned actors. Screening systems assign risk scores based on proximity. Direct exposure is one hop away, indirect is two or more. Shared infrastructure and exchange wallets can create misleading signals. Screening requires interpretive analyst review. Wallet screening is both technical and interpretive. Attribution quality determines enforcement risk. One of the most common misunderstandings in crypto sanctions compliance is the difference between a sanctioned entity and a sanctioned address. When an entity is designated, the prohibition applies to any property in which it has an interest. That may include multiple wallet addresses, even if those addresses are not individually listed. In contrast, sometimes OFAC designates a specific wallet address. In that case, the prohibition applies directly to that address. But the entity behind it may not be fully identified. This creates two different types of risk. Entity-level risk is broader. Crypto actors frequently rotate addresses and create new wallets. They fragment infrastructure. If screening relies only on static address lists, exposure can be missed. Attribution becomes essential. Understanding the distinction determines how screening systems are designed. Entity-level designation carries systemic risk. Address-level designation carries tactical risk. Sanctions compliance is not just matching addresses. It is identifying control. Sanctions compliance is not only about screening names and addresses. It is also about controlling access. Geo-blocking is one of the most basic sanctions control mechanisms in crypto. Platforms must implement controls to prevent access from prohibited jurisdictions. Users may bypass these restrictions using VPNs. But controls are only effective if they are enforced. Regulators look for active facilitation of circumvention. A technical failure may trigger civil exposure. But active facilitation, even indirect encouragement, can elevate the risk to criminal liability. If growth incentives override compliance controls, geo-blocking becomes symbolic. Sanctions compliance is not just technical, it is cultural. Symbolic controls do not protect against enforcement. True compliance requires effective, not symbolic, measures. Many crypto firms believe that operating offshore protects them from U.S. sanctions enforcement. That assumption is dangerously incomplete. Secondary sanctions allow the United States to impose consequences on non-U.S. persons who engage in significant transactions with sanctioned actors. These consequences can include restrictions on U.S. financial access, loss of correspondent banking, asset freezes, or even SDN designation. Global markets are interconnected. Even offshore exchanges often rely on liquidity providers or dollar clearing systems that touch U.S. infrastructure. Jurisdiction is not just about where you are located. It is about where your financial relationships connect. In August 2022, the U.S. Treasury designated Tornado Cash under IEEPA. Tornado Cash was not a company. It was a set of smart contracts deployed on the Ethereum blockchain. This raised an unprecedented legal question: can immutable code be sanctioned as property? OFAC argued that the smart contracts constituted property in which sanctioned actors had an interest. Specifically, the designation was linked to alleged use by North Korea's Lazarus Group. In 2024, the Fifth Circuit Court of Appeals partially reversed the lower court's decision. The court held that immutable smart contracts themselves may not qualify as property subject to blocking under IEEPA. The case clarified limits, but did not eliminate sanctions authority in crypto. Sanctions law is evolving in real time. When technology challenges definitions, courts may redraw boundaries. But enforcement risk remains. Innovation does not suspend statutory authority. It tests it. North Korea represents one of the most significant sanctions risks in crypto. The Lazarus Group, linked to the Democratic People's Republic of Korea, has been repeatedly designated. Operations typically begin with a major exploit: centralized exchanges, cross-chain bridges, DeFi protocols. Once funds are obtained, rapid fragmentation occurs. Assets are split across hundreds or thousands of wallets. Then comes layering. Chain hopping between Bitcoin, Ethereum, and privacy-enhanced assets. Chain hopping, mixers, bridges, and stablecoins are used to delay attribution. The objective is not anonymity. It is delay. Delay complicates attribution and recovery. Over time, funds move toward OTC brokers or high-risk jurisdictions. Sanctions compliance is now inseparable from blockchain analytics. Geopolitical risk is operational risk. State-sponsored actors are among the most sophisticated adversaries in the ecosystem. Stablecoins have become a central enforcement mechanism in crypto sanctions. Unlike Bitcoin, many stablecoins are centrally issued. This means there is an identifiable issuer with technical control over contract functions. That control includes the ability to freeze addresses. When a wallet is designated under sanctions law, stablecoin issuers may block transfers or freeze balances associated with that address. This transforms stablecoins into a compliance choke point. Issuers must assess their obligations under applicable sanctions regimes. If a designated address holds stablecoins, the issuer may be legally required to prevent further movement. However, freezing mechanics raise operational questions. What if the address is one hop removed? What if attribution is disputed? What if freezing impacts innocent counterparties? Stablecoins are not just digital dollars. They are enforcement infrastructure. And issuer governance directly impacts sanctions compliance across the ecosystem. Smart contracts challenge traditional sanctions concepts. Can immutable smart contract code qualify as property under sanctions law? Under U.S. law, IEEPA allows blocking of property and interests in property. If governance token holders vote on protocol changes, do they exercise control? Regulators increasingly examine whether decentralized governance is truly decentralized. If a protocol continues autonomously, who bears responsibility? Sanctions law traditionally attaches to persons. But decentralized systems complicate attribution. Decentralization does not automatically eliminate exposure. Exposure follows control. Smart contracts operate in a jurisdictional environment that is still evolving. The travel rule and sanctions compliance operate in parallel. But operationally, they collide. The travel rule requires VASPs to collect and transmit originator and beneficiary information for qualifying transactions. Sanctions require screening before engaging in a prohibited transaction. The tension arises in timing. When exactly should sanctions screening occur? Before information is transmitted? After identification? Or simultaneously? If a beneficiary wallet is linked to a sanctioned actor, transmitting data could itself create compliance exposure. Counterparty identification is also a challenge. If attribution is incomplete, both regimes create uncertainty. Travel rule is about transparency. Sanctions are about prohibition. When transparency reveals a prohibited counterparty, action must be immediate. Compliance teams must integrate screening and travel rule workflows. In crypto, regulatory obligations intersect at the transaction layer. In sanctions compliance, timing determines liability. There are two primary screening models, real-time and batch. Real-time screening evaluates transactions before execution. If a wallet or counterparty is flagged, the transaction is blocked immediately. This minimizes sanctions exposure. Batch screening processes transactions first, then screens afterward. If a prohibited transaction is detected later, remediation becomes reactive. Funds may already have moved. A prohibited transaction does not become permissible because it was detected late. Strict liability still applies. The longer the delay, the higher the risk. Real-time systems reduce risk but increase operational complexity. The challenge is calibration, balancing sensitivity with user experience. In sanctions law, exposure attaches at the moment of transaction. The insight is simple: screen before you execute. Sanctions compliance and AML compliance are often confused. But they operate under fundamentally different legal standards. AML is risk-based. In AML, institutions are required to identify, assess, and mitigate risk. If controls are reasonable and proportionate, regulators evaluate the framework. Intent and context matter. Sanctions are strict liability. If a prohibited transaction occurs, liability can attach regardless of intent. You do not need to know the counterparty is sanctioned. You do not need to intend to violate the law. The mere occurrence of a prohibited transaction may trigger enforcement. This is the essence of strict liability. AML asks, did you implement adequate controls? Sanctions asks, did the transaction happen? AML evaluates controls. Sanctions evaluates outcomes. There is no risk tolerance for designated parties. Sanctions compliance is not risk tolerance. It is prohibition. Understanding this is foundational to effective crypto compliance. Not every sanctions alert is a true match. False positives are inevitable in sanctions screening. Names can be similar. Wallets can share infrastructure. Entities may resemble sanctioned parties without being designated. When legitimate transactions are blocked, operational friction increases. Users experience delays. Liquidity is interrupted. Counterparties lose confidence. At the same time, underblocking creates regulatory exposure. Overblocking can trigger reputational damage. Institutional clients expect precision. Repeated false freezes erode trust. The calibration challenge is constant. Screening thresholds must balance sensitivity and specificity. Too loose, and violations occur. Too strict, and business suffers. Effective sanctions compliance is not about blocking everything. It is about blocking accurately. Precision is protection. Sanctions alerts do not end with blocking. They trigger reporting obligations. Under sanctions law, if a transaction involves blocked property, you must file a report with OFAC. This is mandatory. Initial reporting is typically required within 10 business days. AML reporting is different. SARs are filed with FinCEN, focusing on suspicion of criminal conduct. OFAC reports focus on prohibited transactions. The destinations and legal standards are different. A sanctions match does not automatically require a SAR. The triggers are not the same. Escalation pathways must be separate. Sanctions go to officers, suspicion to AML teams. Sometimes, both apply. Sanctioned actors engaging in suspicious activity require dual reporting. Sanctions is about prohibition. SAR is about suspicion. This distinction prevents regulatory gaps. A sanctions settlement is not the end of enforcement. It is the beginning of oversight. When serious violations occur, regulators often require independent monitoring. An independent monitor evaluates compliance improvements. This monitor reports directly to regulators, not to management. Monitoring periods typically last up to 5 years. Remediation obligations go beyond paying a fine. Institutions must upgrade screening systems and revise escalation frameworks. They must also hire additional compliance staff, enhance training programs, and implement new governance controls. In some cases, deferred prosecution agreements impose strict behavioral conditions. All systems and governance are reviewed in detail. Failure to comply can reactivate criminal exposure. Monitoring is expensive and requires intense internal resources. Management shifts from growth to compliance rebuilding. Institutional partners and correspondent banks reassess their risk exposure. Financial penalties are immediate. Regulatory oversight is sustained. Understanding the long-term cost is critical for compliance. Sanctions obligations often depend on whether someone is a U.S. person. But in crypto, that definition is frequently misunderstood. Under U.S. law, this includes citizens, residents, U.S. entities, and anyone physically in the United States. Physical presence is most overlooked. Even tourists are subject to U.S. sanctions law while on U.S. soil. In crypto, geographic boundaries are digital. But sanctions law remains territorial. Understanding this is foundational. Sanctions exposure can arise from server location, dollar clearing, subsidiaries, or personnel on U.S. soil. A non-U.S. exchange may believe it avoids U.S. rules, but if a user logs in from U.S. territory, jurisdiction may attach. If a compliance officer reviews a transaction while in the U.S., U.S. law applies to that action. Jurisdiction is about connection. Sanctions liability often begins with jurisdiction. Being offshore does not shield a firm from U.S. sanctions. Dollar clearing is the most common nexus trigger. If a transaction touches the U.S. financial system, jurisdiction may attach. This includes correspondent banks processing U.S. dollar payments, even between non-U.S. entities. Servers located in the United States can also create exposure. So can U.S.-based employees or ownership. If a company is majority-owned by U.S. persons, sanctions may apply globally. Secondary sanctions extend pressure even without direct U.S. contact. This is not theoretical. Major global banks have paid billions in penalties. Crypto is no exception. Using U.S. dollars, serving U.S. persons, or U.S. infrastructure, all create jurisdiction. Sanctions law follows connection, not geography. Enforcement risk begins with jurisdiction. Sanctions are not only a compliance issue. They are also a geopolitical conflict. The EU blocking statute was created to counter certain U.S. extraterritorial sanctions. It prohibits EU companies from complying with certain U.S. sanctions unless authorized. In practice, most global financial institutions choose to comply with U.S. sanctions. They prioritize access to U.S. dollar clearing even when EU law discourages it. For crypto platforms serving both U.S. and EU users, this creates structural risk. Ignoring OFAC exposure risks losing access to the global financial system. In cross-border sanctions, legal exposure is shaped by politics as much as law. Sanctions enforcement rarely begins with prosecution. It often begins with banking pressure. Correspondent banking relationships are the backbone of global finance, allowing banks to clear transactions in major currencies. If a bank is perceived as high risk, partners may terminate the relationship, a process known as de-risking. For crypto firms, de-risking is existential. It threatens access to fiat on-ramps, payroll, and operational liquidity. Banks assess regulatory risk conservatively. Weak sanctions controls can trigger a loss of banking access without formal charges. This creates indirect enforcement. Regulators may not shut down a platform, but de-risking can achieve the same effect. Compliance is about preserving financial connectivity. Because without correspondent banking, global crypto operations cannot function. When a bank exits a crypto client, the impact is immediate. Accounts may be frozen. Payment rails may be suspended. Settlement channels may disappear overnight. Banking access is operational oxygen. Without it, fiat on-ramps stop and customer withdrawals slow or halt. Liquidity fragments. A single banking termination can trigger a cascade. Institutional partners reassess exposure. Payment processors increase scrutiny. Custodians reevaluate counterparty risk. The message is clear. Banking institutions prefer to exit risk rather than manage uncertainty, even if no violation is proven. For crypto firms, this creates an indirect enforcement mechanism that can effectively limit operations. In global finance, access to the banking system defines legitimacy. Sanctions resilience determines survival. In November 2023, Binance entered into a $4.3 billion global settlement with U.S. authorities. Of that total, approximately $968 million related specifically to OFAC sanctions violations. This was not a minor compliance oversight. OFAC determined that Binance processed transactions involving comprehensively sanctioned jurisdictions, including Iran, Cuba, Syria, and certain regions of Ukraine. OFAC cited several factors, including the failure to implement effective sanctions screening controls and the failure to prevent U.S. persons from engaging in prohibited transactions. The scale matters. Volume amplifies enforcement response. This portion of the settlement sent a clear message: sanctions exposure is independently material. The Binance case redefines sanctions risk in crypto, not as a peripheral compliance issue, but as a primary regulatory threat. In 2022, Kraken settled with the U.S. Treasury's Office of Foreign Assets Control for sanctions violations. OFAC determined that Kraken had processed transactions for users located in Iran, a jurisdiction subject to comprehensive U.S. sanctions. Kraken had geo-blocking measures in place, but those measures were not fully effective at preventing prohibited access. This was a civil enforcement action, illustrating a critical principle: sanctions violations operate under strict liability. Intent is not required. Even inadvertent processing of prohibited transactions can trigger penalties. Proportional enforcement applies, but the exposure remains. Kraken cooperated with OFAC and implemented remediation measures, including enhanced geolocation controls and strengthened oversight. Sanctions compliance is measured by outcome, not just intention. If a prohibited transaction occurs, exposure exists, even with reasonable controls. BitMEX is widely known for its AML enforcement case. But sanctions exposure was embedded within the same compliance weaknesses. U.S. users accessed the exchange despite stated restrictions. Geographic controls were insufficient. Jurisdictional exposure was underestimated. When a platform cannot reliably identify its users, it cannot reliably screen them against sanctions lists. This is where AML and sanctions intersect operationally. Compliance deficiencies compound. Weak KYC. Weak geo-blocking. Weak monitoring. Together, they increase regulatory vulnerability. When enforcement begins, regulators evaluate the total compliance posture, not only the specific charge. In crypto, AML weaknesses and sanctions exposure frequently travel together, because identification is the foundation of both regimes. Sanctions resilience does not begin with enforcement. It begins with design. A sanctions-resilient crypto platform integrates controls at the architectural level. First, jurisdictional clarity. You must know where your users are located, where your infrastructure operates, and where regulatory nexus may arise. Second, identity integrity. Effective KYC is a critical sanctions control mechanism. Without reliable identification, sanctions screening collapses. Third, real-time wallet screening. Screen before transaction execution, not after settlement. Batch review increases exposure velocity. Fourth, governance separation. Sanctions review must have independent escalation authority. Fifth, continuous testing. Simulate evasion attempts and stress test geo-blocking. Finally, documentation discipline. Resilience is the ability to prevent, detect, and contain exposure. Design determines survivability. Sanctions are not a secondary compliance issue. They are an existential risk. Unlike AML, sanctions operate under strict liability. Sanctions law is geopolitical. It reflects national security priorities and applies extraterritorially across the global financial landscape. A crypto firm doesn't need to be based in the US to fall under its jurisdiction. Any nexus, users, infrastructure, or dollar clearing can trigger exposure. Enforcement can trigger banking exits. Once relationships deteriorate, operational viability collapses, affecting liquidity access and institutional partnerships. The lesson is strategic. Sanctions compliance is about preserving access to markets, infrastructure, and legitimacy in an increasingly regulated world. Resilience is not optional, it is structural. And structural resilience determines survival.